Welcome, everyone. Today, we are diving into the exciting world of the exponential moving average crossover strategy. By the end of this journey, you will know exactly how to use these exponential moving averages to identify buy and sell signals. This will help you make better, smarter, and more informed trading decisions. So stay tuned and let us jump right in. Imagine if you could get a clear signal that tells you when a market trend is starting or about to change direction. What if you could use that signal to make smarter trading decisions and stay one step ahead? That is exactly what we are talking about today, starting with a simple question. What exactly is an exponential moving average? You may have heard this term tossed around before, but let us break it down so it is super clear. An exponential moving average is a type of moving average that focuses more on recent price data. This means it reacts faster to what is happening right now compared to the simple moving average, which treats all price data equally. Because of that faster reaction time, the exponential moving average helps us see trends and potential changes earlier than other types of averages. And that can be a real game changer when trading. While understanding the exponential moving average is crucial, we can take our analysis a step further by incorporating chart patterns. Chart patterns are visual representations of price movements that help traders make predictions about future trends. Some common chart patterns you might encounter include head and shoulders, double tops and bottoms, triangles, and flags. Each of these patterns can give us hints about whether a trend is likely to continue or reverse. The head and shoulders pattern, for example, is a reversal pattern. It often signals that an uptrend is about to end and a downtrend may start. It has three peaks, with the middle peak being the highest, resembling a head between two shoulders. When the price breaks below the support level, called the neckline, it confirms the reversal and indicates a potential sell signal. The inverse head and shoulders is just the opposite, signaling a potential bullish reversal. Double tops and double bottoms are also powerful reversal patterns that can provide critical insights into market dynamics. A double top looks like the letter M and suggests that an uptrend is about to reverse into a downtrend. This pattern is characterized by two peaks at roughly the same price level, separated by a trough. The double top is confirmed when the price breaks below the support level formed by the trough between the two peaks, indicating that buying pressure has weakened and sellers are taking control. Traders often use this confirmation to initiate short positions or exit long positions. A double bottom, on the other hand, resembles the letter W and indicates a possible reversal from a downtrend to an uptrend. This pattern forms when the price hits a low point, rebounds, and then retests the same low point again before moving higher. The double bottom is confirmed when the price breaks above the resistance level formed by the peak between the two lows, signaling that selling pressure is exhausted and buyers are gaining momentum. This confirmation is often used by traders as a signal to enter long positions. It is essential to watch for volume when identifying double tops and double bottoms. In a double top, volume often declines during the formation of the second peak, indicating waning buying interest. A significant increase in volume when the support level breaks provides further confirmation of the downtrend. In a double bottom, the volume pattern is the opposite. You may see an increase in volume during the formation of the second low, suggesting that buyers are stepping in, and a further increase when the resistance level is broken, confirming the uptrend. These patterns help traders understand when a trend is weakening and might reverse, offering opportunities to capitalize on significant market moves. Triangles are continuation patterns that show a period of consolidation before the trend continues in the same direction. There are ascending triangles, descending triangles, and symmetrical triangles. For instance, an ascending triangle usually indicates that a price breakout to the upside is likely. It forms when the price hits a horizontal resistance level multiple times but forms higher lows, suggesting increasing buying pressure. Flags are short-term continuation patterns that indicate a brief pause in a strong trend before the trend continues. Flags are formed by a sharp price movement followed by a period of consolidation that slopes against the prevailing trend. They are useful in identifying opportunities to join an ongoing trend after a minor pullback. By combining exponential moving averages with chart patterns, you get a more complete picture of market trends. For example, if you see a bullish crossover in the exponential moving averages alongside an ascending triangle pattern, it strengthens the buy signal. Similarly, if you notice a bearish crossover and a head and shoulders pattern forming, it reinforces the sell signal. These combinations give you greater confidence in your trading decisions and help you filter out false signals. Now you might be wondering, what is this crossover strategy everyone talks about? Let us make it really simple. The exponential moving average crossover strategy is all about using two different exponential moving averages to help spot when trends are changing. We use one short-term moving average and one long-term moving average. A crossover happens when the short-term average crosses either above or below the long-term average. When this happens, it often gives us a strong signal to either buy or sell. This works because it filters out all those tiny price movements that do not really matter. Instead, it focuses on bigger trends in the market. It helps us ignore the random ups and downs and pay attention to what is actually happening. This keeps us focused on the larger movements that are more likely to be reliable and, let us face it, more likely to help us make good trades. To get started with the exponential moving average crossover strategy, the first thing you need to do is choose your time frames. Do not worry if you are new to this. The common setup is to use a 12-day exponential moving average for your short-term trend and a 26-day exponential moving average for your long-term trend. You do not need to stick with these numbers forever, but they are a good place to start if you are learning. Most charting platforms will make this really easy for you. You just need to select the exponential moving averages, choose 12 days for the short term and 26 days for the long term, and add them to your price chart. Once you do that, you will start to see these lines moving across your chart. Watching how these lines interact with price action will help you understand where trading opportunities might be. It is also helpful to recognize and understand various chart patterns while observing these exponential moving averages. Chart patterns can provide additional insights into where the market might be headed. For instance, you might notice a bullish flag pattern forming right around the time of a bullish crossover. This kind of confluence is powerful and often suggests a strong upward move is ahead. In addition to flags, other common chart patterns that can be very useful include triangles, head and shoulders, wedges, double tops and bottoms, and channels. Each of these patterns gives a unique perspective on market sentiment and potential price movements. For example, the ascending triangle is a bullish continuation pattern that occurs during an uptrend. It forms when there is a series of higher lows that meet a horizontal resistance line, indicating strong buying pressure. If this pattern forms while you also see a bullish exponential moving average crossover, it is a strong signal that a significant breakout to the upside may occur. Descending triangles, on the other hand, are bearish continuation patterns that often appear in downtrends. They feature a series of lower highs converging towards a horizontal support level. If a bearish crossover aligns with a descending triangle, it can indicate a continuation of the downtrend. The head and shoulders pattern is one of the most well-known reversal patterns. It signals a change in trend direction. The traditional head and shoulders pattern, which forms during an uptrend, signals that a reversal to the downside is likely. It consists of 3 peaks, with the middle one being the highest. When the price breaks below the neckline, it confirms the reversal. When this pattern aligns with a bearish crossover, it is often a strong indication that the market will continue moving lower. Conversely, the inverse head and shoulders pattern signals a potential upward reversal during a downtrend. Wedges are also important to watch. Falling wedges are bullish reversal patterns that occur after a downtrend, suggesting that the market may be about to move higher. Rising wedges, on the other hand, are bearish and indicate a potential move down after an uptrend. When a falling wedge forms alongside a bullish crossover, it adds confidence that the trend is shifting upwards. Channels, whether ascending or descending, are another key pattern. Price moves within these parallel lines, and a breakout from the channel often signals a strong trend continuation. If an ascending channel breaks upwards at the same time as a bullish moving average crossover, it strengthens the buy signal. Double tops and double bottoms are powerful reversal patterns, as discussed earlier, and can be particularly significant when combined with exponential moving average crossovers. A double top, when confirmed by a bearish crossover, suggests that the uptrend is losing momentum and that sellers are beginning to take control. Conversely, a double bottom confirmed by a bullish crossover is a strong signal that buyers are gaining strength. By thoroughly understanding and applying these chart patterns while observing exponential moving averages, you can build a more comprehensive strategy for identifying high-probability trading opportunities. Recognizing these patterns and how they interact with moving average signals helps you make more informed and confident trading decisions. Let us explore a few additional chart patterns in more detail. The wedge pattern, for example, is a significant pattern that can indicate either a continuation or reversal of a trend depending on its shape and positioning. Falling wedges tend to be bullish, indicating a potential upward breakout, whereas rising wedges are often bearish and suggest an impending downward breakout. Identifying these patterns, combined with the direction of the exponential moving averages, can help you time your trades more effectively. Another important pattern to consider is the pennant. Pennants are continuation patterns formed after a strong price movement, followed by a short consolidation period before the trend continues. They look similar to small symmetrical triangles, but typically occur after a significant up or down move. Pennants represent a moment where the market takes a breath before continuing in the same direction. You will often see volume decrease during the consolidation phase and then spike again when the breakout happens, which helps validate the pattern. When combined with a crossover, these patterns can be quite effective in signaling whether the trend will continue. Another similar continuation pattern is the flag, which can also signal the potential for further movement in the prevailing trend. Unlike pennants, flags are characterized by parallel lines during the consolidation period, giving them a rectangular appearance. Flags form after a strong price move and tend to slope against the trend direction. This consolidation period allows the market to absorb gains before continuing in the original direction. When a breakout from the flag occurs, especially with increased volume, it often signals a strong continuation of the prior trend. In addition to these patterns, channels are also useful tools for identifying trend continuations or reversals. Channels are formed by drawing two parallel lines along the price action, marking the upper resistance and lower support levels. Price tends to bounce within these channels until a breakout occurs. An upward breakout from an ascending channel often signals a continuation of the bullish trend, while a breakdown from a descending channel may indicate that a bearish trend will continue. Watching how price interacts with these channels alongside exponential moving averages provides valuable clues for when a trend might accelerate or reverse. Broadening patterns, sometimes called megaphone patterns, are another chart feature that traders should be aware of. These patterns are marked by increasing price volatility and are identified by drawing diverging trend lines that create a broadening shape. They can signal a potential trend reversal, especially when accompanied by bearish or bullish crossovers. These patterns reflect indecision in the market, where the range widens before eventually breaking in one direction. Recognizing a broadening pattern can help you prepare for heightened volatility and potential breakouts. By thoroughly understanding and applying these chart patterns in conjunction with exponential moving averages, you are better equipped to anticipate market movements. Each pattern provides context that helps you interpret what the market might be signaling, and when these patterns align with moving average signals, they can provide a robust framework for your trading strategy. Candlestick patterns are also worth watching alongside your exponential moving averages. Patterns such as engulfing candles, hammer, and shooting star can provide early clues about potential reversals or continuations. For example, if you see a bullish engulfing pattern forming near a bullish crossover, it strengthens the buy signal. Conversely, a shooting star near a bearish crossover can serve as an early warning to exit your position. By paying attention to these chart patterns alongside your exponential moving averages, you get a fuller and more nuanced view of market dynamics. Recognizing when a pattern aligns with an exponential moving average signal allows you to filter out weaker setups and focus on high probability trading opportunities. Alright, so you have got the exponential moving averages on your chart. How do you use them to figure out when to buy and when to sell? Let us break it down simply. A bullish crossover happens when the short-term exponential moving average crosses above the long-term exponential moving average. When you see that, it means an uptrend might be starting, which is often a sign that you might want to buy. On the flip side, a bearish crossover is when the short-term average crosses below the long-term average. This usually means a downtrend is starting, and that can be a sign to sell or to stay out. For example, imagine you are looking at a stock chart and you see that the 12-day exponential moving average crosses above the 26-day exponential moving average. This is a bullish signal. It could be time to consider buying. These crossovers are moments when the market may be changing direction, and knowing how to read them can make a big difference in your trading. It is also helpful to look for other confirming chart patterns during these crossovers. For instance, a bullish crossover that coincides with a double bottom pattern or an ascending triangle can be an even stronger indication that the trend is reversing upwards. The double bottom pattern, resembling the letter W, suggests that selling pressure is exhausted and a reversal to the upside may occur. Meanwhile, an ascending triangle formed by a horizontal resistance line and rising support levels points to increased buying interest and a potential breakout. Similarly, when a bearish crossover occurs, it can be helpful to spot patterns like the head and shoulders or a descending triangle. The head and shoulders pattern is one of the most reliable reversal signals and suggests a change from an uptrend to a downtrend. A descending triangle with its horizontal support line and falling resistance levels often signals a breakdown and continuation of a bearish trend. By combining these chart patterns with exponential moving average crossovers, you can enhance your ability to identify high probability trading opportunities and avoid false signals. Additionally, looking for candlestick reversal patterns, such as a bearish engulfing near a bearish crossover or a hammer candlestick near a bullish crossover, can provide even more confirmation for entering or exiting a trade. Candlestick patterns add another layer of depth to your analysis, allowing you to gauge market sentiment and act accordingly. This combination of crossovers and chart patterns gives you the best possible picture of where the market might be headed, helping you make more informed decisions. But how do you actually use this strategy for timing your trades? Here is what you need to know. You enter a trade when you see the short-term exponential moving average crossing above the long-term one. This means an uptrend might be forming, and this is when you can consider buying. When do you get out of the trade? When you see a bearish crossover. If the short-term exponential moving average crosses below the long-term one, that is your signal to sell or to close your position. Something very important here is managing risk. Always use stop-loss orders when trading. These are not optional if you want to protect yourself. For this particular strategy, a good place to set your stop loss is just below the most recent support level or below the longer-term exponential moving average. This way, if the market moves against you quickly, you will be protected from major losses. Now, let us take this strategy one step further by combining it with other indicators to make your signals more reliable. One great tool to use is the Relative Strength Index. The Relative Strength Index can help confirm your buy or sell signals. For instance, if you see a bullish crossover and the Relative Strength Index is showing oversold conditions, it means the market may be ready to move up. This gives you extra confidence that the buy signal is strong. Another helpful tool is the Moving Average Convergence Divergence. This is a fancy name for a really useful indicator that is also based on exponential moving averages. The Moving Average Convergence Divergence consists of two lines, the Moving Average Convergence Divergence line and the Signal line. When the Moving Average Convergence Divergence line crosses above the Signal line, it indicates bullish momentum, whereas a cross below suggests bearish momentum. If the Moving Average Convergence Divergence line crosses above its Signal line during a bullish crossover, it gives you even more evidence that a trend is beginning. Likewise, if the Moving Average Convergence Divergence line crosses below its Signal line during a bearish crossover, it can be a strong signal to sell or exit a position. The Moving Average Convergence Divergence also has a histogram that represents the difference between these two lines, which helps traders identify changes in momentum more easily. Another chart pattern that is worth mentioning is the cup and handle pattern. The cup and handle pattern is a bullish continuation pattern that looks like a teacup. The cup forms after a rounded bottom and represents a period of consolidation, while the handle forms as a short period of downward movement before the price breaks out to new highs. When combined with a bullish exponential moving average crossover, a cup and handle pattern can give a strong buy signal, especially when confirmed by high volume. And finally, do not ignore volume. When you see a crossover, it is always stronger if it happens with high volume. This means there are many traders supporting the move, making it more likely to continue. Volume acts as a confirmation tool, so whether you are seeing a bullish or bearish crossover, always check the accompanying volume. Strong volume confirms that the market is committed to the direction, while low volume might suggest a weaker or unreliable signal. Let us talk about adapting this strategy for different trading styles, because not everyone trades in the same way. If you are a day trader, you want to use shorter exponential moving averages like a 5-day and 10-day. This will help you capture quick movements and stay on top of intraday trends. For those of you who are swing traders, the 12-day and 26-day combination works well. It helps you follow trends that last several days or even weeks. For long-term investors, the 50-day and 200-day exponential moving averages are more useful. They help you identify major market trends and avoid all the small, random price movements that do not matter for longer-term investing. One thing you need to be aware of is that even though this strategy is powerful, there are some common mistakes people make. Do not fall into the trap of reacting to every single crossover. Not every crossover is significant, and many will simply be false signals that can lead to unnecessary losses. To avoid this, always use other indicators like volume, relative strength index, or moving average convergence, divergence to confirm the signal and filter out noise. Another mistake is ignoring the broader market context. Technical indicators are powerful, but they cannot predict significant news events or economic data releases. For instance, if major economic news is expected, it could lead to unexpected price movements that invalidate what seems to be a perfect technical setup. Make sure you are aware of upcoming news, earnings reports, or economic announcements that could impact your trades, even if the moving averages look ideal. Another common mistake is failing to understand the time frame of your analysis. Signals on a daily chart are more meaningful for longer-term trades, while signals on a 5-minute chart are better suited for intraday trades. Always make sure that your strategy matches the time frame you are analyzing. Lastly, always use stop losses to protect yourself. This is especially important in trend-following strategies like this one, as market reversals can be swift and unpredictable. Proper risk management ensures that one bad trade will not erase your profits. Place stop losses below recent support levels or key moving averages to give your trades room to breathe, while still protecting against major moves against your position. Now, before you go out and start using this strategy with real money, it is a good idea to practice first. Most brokers have demo accounts that you can use to practice without risking any real money. This is a great way to get comfortable with the exponential moving average crossover strategy and to figure out how it works best for you. Another great idea is to keep a trading journal. Track your trades, write down why you took them, and then review them to see what worked and what did not. Over time, this will help you improve your strategy and make better decisions. Do not forget to experiment with different time frames as well. You might find that the 12-day and 26-day combination works well for one type of market, but a 5-day and 15-day combination is better for another. Additionally, do not hesitate to try longer time frames like the 50-day and 200-day combination, especially for larger trends that are suited to swing trading or position trading. Each market behaves differently, and certain timeframes may perform better depending on the asset you are trading, the market conditions, and even the time of year. Keep testing and refining your approach, and consider combining these timeframes with different chart patterns to strengthen your trading strategy. For instance, shorter moving averages can be effective for identifying quick trades within broader patterns like flags or pennants, while longer moving averages can help validate trends when coupled with patterns such as head and shoulders or double tops and bottoms. By incorporating various timeframe strategies and chart patterns, you will develop a more flexible and adaptive approach to your trading decisions. All right, let us recap. The exponential moving average crossover strategy is a simple but powerful way to identify buy and sell signals. We use two exponential moving averages, one for the short term and one for the long term, to tell us when a trend might be changing. A bullish crossover is a signal to buy, and a bearish crossover is a signal to sell. You can practice this strategy in a demo account, use other indicators to confirm your signals, and always manage your risk with stop losses. The exponential moving average crossover strategy is not complicated, but it is highly effective if you take the time to learn it and practice. With patience and careful practice, you will be able to spot trends, make confident decisions, and improve your trading performance. I hope you found this guide helpful. Feel free to ask questions or share your thoughts as you explore and practice this strategy. Stay focused, keep learning, and you will do great.